Or undervalued dividend stocks that investors have been buying. We're going to take a look at each one, their historical performance. We'll look at their dividend safety. We'll jump into their financial metrics. And as always, we'll run them through the valuation model, getting to our intrinsic value, finding our acceptable buy price, given that investor margin of safety. And as always, we'll see what Wall Street are forecasting for the price over the next 12 months. So the first dividend stock that investors have been buying is ADP, Automatic Data Processing. Now this is up 14% over the last year. We can see it towards the mid to upper end of the 52-week range. If you've been holding this over the last 10 years, well, you would be up around 260%. Just bear in mind that doesn't include those dividends reinvested, and the current yield sits at 2.24% and a forward PE of 27.36. In terms of the dividend safety score, 97, very safe. Market cap, 103 billion. It is a mega cap company. Recessionary metrics, for those that see a recession inbound, well, they increased the dividend during the last recession, 07-09. They had above average growth, -3% versus the S&P's -12, and they also significantly outperformed the S&P with a -29% return versus the S&P's -55. Dividend growth, I really love this company with their dividend increases. 12% last November, double digits over the last 5 years, double digits over the last 20 years, looking very, very strong. And they are literally 1 year away from becoming a dividend king. When they increase that dividend at the end of November this year, they will officially get that dividend king status. In terms of dividend yield theory, for those that are new, it states a company is undervalued when the current yield sits above the 5-year average. Right now, we have a double sign of undervaluation, yield of 2.24 above the yield of 2.02, and also the forward PE 26.2 sitting below the 5-year average of 27.9. We can also see, though, the industrial sector PE of 19.7 is lower than that of automatic data processing. Now, in terms of their free cash flow payout, remember, we focus on the free cash flow. Earnings data, you can have a look if you prefer it, but it is susceptible to manipulation by management through accounting. My personal rule, blanket of 60% or lower, gives me faith that management can offer those double-digit increases we love to see with ADP. What we can see is, over the last 10 years, it has straddled around that 55% in 2023, 45% expected in 2024, so I would be really surprised if we don't see a nice double-digit dividend increase this year. Free cash flow per share nearly tripled over the last 10 years, 317 in 2014, 879 in 2023, 2024 expected to go even higher at $12.30. This is a very, very strong performance from this company. That free cash flow over the longer term is moving in the right direction at a very decent and consistent basis. In terms of sales growth, well, we're looking for steady, moderate growth around 3 to 7%, and ADP do hit that, and in fact, even better for the large part of the last 10 years. 2023, 9% looking very solid. 2022, we saw that double-digit increase of 10% to their top line. Total sales, then, it has increased by 80% over the last 10 years, going from around 10 billion in 2014 to 18 in 2023. On top of that, we see a lot of excess cash returned to shareholders through share buybacks, reducing their count from 483 million to 414. That, coupled with that lovely dividend increases consistently, is great for shareholders. ROIC, now as always, we're looking for 10% or more. Now this gives us faith that management are able to effectively allocate their capital. And what we can see, the metric has been increasing over the last 10 years, looking very, very positive. 64% in 2023. This is absolutely phenomenal and should be taken into serious account when looking at your investment thesis. Operating margin, now I love this for two reasons. One, it is consistently above that 12%. Two, we're seeing some strong operational efficiencies here, with the margin increasing from 18% to 25% consistently over the last 10 years. This is very, very important and is a big plus when analysing companies, when seeing their efficiencies increase over the longer term. And what we can see, the free cash flow margin, again, consistently above the 5% that we look for most companies, and very strong. I mean, 2023, 20% looking very, very positive. In terms of the net debt to EBITDA, I mean, this is a company with absolutely phenomenal metrics. Net debt to EBITDA, so the earnings before interest, tax, depreciation, amortization. Remember, this correlates to two things: the strength of the balance sheet as well as the dividend safety, showing us here that in 2023 it would take them 0.28 years to pay off all of their debt net of cash on hand. Very, very strong. 2024 expected to be near enough the same, so no worries with the dividend safety, and the balance sheet for now looks to be incredibly strong. What about the valuation? Well, as always, if you are enjoying the content, value is being provided. Smash that like button, hit that subscribe and bell button so you are continually notified of these videos as they drop. Now, typically on the channel, we do deep dives of companies and we run through every single one of these models. In today's episode, let's jump straight into the intrinsic value. And for ADP, we're arriving at $287. Now, this is a very high quality company in my opinion, and what we do here is we start off with a margin of safety. We use 10% if we believe it meets three criteria: a wide moat, strong financial metrics, and good forward-looking data. If you believe that, then it is an acceptable buy up to $259, and we keep going till it's near enough that current trading price. So it isn't at 244 yet, but we do see around 10 to 15% margin of safety for ADP. In terms of Wall Street and their forecast for the next 12 months, they have a price target of $267, so they see upside of 7%. As always, when we go through these stocks, let us know your thoughts in the comments whether or not you have been buying any of these companies. We then move on to a company that we haven't reviewed yet on the channel, which is eBay Incorporated. Now, this is up around 5% over the last year. Over the last 10 years, up around 93%. And we can see it did hit its all-time highs October 2021 at $81. Since then, it has started to come down in that downward trend, but it is looking like for a reversal, there is a possibility. It's towards the mid to upper end of the 52-week range with a yield of 2.25% and a forward PE of around 10.32. Dividend safety sits at 70. It looks to be safe. Market cap 25 billion, a large cap company. In terms of those recessionary metrics, well, they didn't pay a dividend in 07-09. However, they did have negative 3.4% recession sales, which was above the average growth. Latest increase literally just last week, 8%, so looking very strong, well above that minimum 4% we advocate on the channel just to keep up in line with inflation. And we can see they've had 3 years of dividend growth streaks, initiating that dividend in 2018. In terms of dividend yield theory, so we have that double sign, a strong double sign of undervaluation, 2.25 versus 1.56, and on the forward PE, 10.3 versus 12.9. And we can also see it is below that consumer discretionary sector PE of 15.2. Now, when we take a look at that free cash flow payout, we can see it is well below that 60% that we look for, 27% consistently over the last 2 years, 29% expected in 2024. So again, a nice dividend increase should be expected. Free cash flow per share pretty inconsistent over the last 10 years. It was at a high of 404 in 2014. 2023 at 372, we do see it does look like it decreased. 2024 expected nearly or pretty much bang on the same. So again, bear that in mind when you are looking at your margin of safety. Sales growth inconsistent. We see a double back-to-back year of double negative growth. Since then, though, it did essentially bounce back as we saw. In the latest year, 3%, so right at the bottom of that 3 to 7% that we look for. So numerically speaking, we have seen it's gone from 8.8 billion to 10.1. Now, this is probably one of the greatest companies at aggressively buying back their shares. I mean, look at this graph, probably the greatest one we have analysed on the channel, reducing their share count to 1.25 billion to around 533 in the latest period. In terms of the ROIC, again, consistently around that 10% level or more. The last few years in the low teens, 12% in 2023, looking pretty positive in my opinion. Operating margin, it does look like it has decreased over the longer term. Let's hope that it does start to go back up to what we like to see. Nonetheless, it is above that 12%, so still, even at that 21% level, which is the lowest over the last 10 years, looking very strong for 2023, so no negatives to talk about with the margin. Free cash flow margin as well from 2016, fairly consistent. 20% in 2023, looking positive. So overall, on their margins, I would say it does look quite nice. Net debt to EBITDA, 0 in 2023, absolutely incredible. 2024 expected to be unchanged, so they have a very strong balance sheet. No massive negatives to talk about eBay when looking at their analysis. So what about the valuation of this company? And don't forget, you can grab a copy of this valuation model if you want to get to the intrinsic value as well as the acceptable buy price of companies in your own portfolio or even those on your watch list. So a 10% margin of safety, a buy up to $59. At 15%, a buy up to $56, and we keep going till it's near the current trading price, and we can see a very strong 25% margin of safety for this company. In terms of Wall Street and their forecast, well, they see 14% upside. They see the share price at around a price target of $55 over the next 12 months. Now, before we jump into the next stock, just to let you know, we have released our latest free weekly article. If you want to gain access to this or many of the others completely free, all you need to do, sign up and click on that pinned comment below. The third stock we're looking at that investors have been buying is Comcast Corporation, up 17% over the last year. Over the last 10 years, however, up 66%, as we can see their all-time highs around that $62 mark in summer 2021. The yield is just below 3%, 2.9 currently, with a forward PE just over 10 at 10.09. A very safe dividend safety score of 89, market cap 170 billion, a mega cap company. In terms of those key metrics, well, they increased the dividend during the last recession, plus 3.4%, and they had around a near recession return of negative 52. Another company that has fairly strong dividend increases, just under 7% this year, 9% on average over the last 5 years, and over the last 10 years, double-digit increases looking very, very strong. They have also been increasing those dividends for the last 15 years. In terms of dividend yield theory, again, a double sign of undervaluation, 2.9 versus 2.18. Forward PE, 10.1, below that 5-year average of 13.7. So we have a double undervaluation signal, and the communications sector PE is much, much higher at 19. In terms of the free cash flow payout, I love this. I love consistency and a very strong metric as well. 37% in 2023, 38% expected in 2024. So these dividend increases should continue in a very strong manner. Free cash flow per share, it is also increasing at a fairly nice rate, 311 in the more recent year, 326 expected in 2024. So I do quite like to see over the longer term a clear picture of increases to the company's free cash flow. Now, 2023, a pretty poor year for Comcast in relation to their top line growth, essentially flat. Previous year, or in fact the previous 2 years, looking pretty decent. And over the longer term, I would say they are at least keeping up with inflation. Numerically speaking, we can see nearly doubled from 69 billion to 122. They also do share buybacks, maybe not as consistently as you would like, but 5.24 billion has been reduced down to 4.15 in that latest quarter. Looking at their ROIC, looking pretty strong around that 10 to 11% level consistently year on year, 11% in the more recent year, looking very nice. Margins as well, very attractive on both the operating and free cash flow margin side. 19% over the last 2 years, well above that minimum 12% that we focus on, and the same can be said for the free cash flow margin. I do quite like seeing a free cash flow margin that is very consistent and above the minimums that we target. Net debt to EBITDA 2.51 in 2023. Now we want to see below 3 for the majority of companies. It is looking to be trending downwards in 2024 as well. So no real concerns there on the dividend front or the balance sheet side for Comcast Corporation. What about the valuation? Let's take a look at the intrinsic value for today's episode, and we're arriving at $52. Now when we plug in that 10% margin of safety, what we can see is an acceptable buy of $47. At 15%, an acceptable buy at $45, and we keep going till we get near the current trading price. So we see again around 61 cents shy from the current value, a 20% margin of safety. In terms of Wall Street and their forecast, well, they see this as a very strong buy. They're signaling around a $52 price target for 2024 and beyond, with 22% upside, making them this one of the undervalued companies that they are looking to add. As always, let me know your thoughts as we go along, as I know this is a very popular choice in the dividend community. We then move on to a very strong company, which is Johnson & Johnson. Now this is up around 6% over the last year. Over the last 10 years, up around 74%. We can see it trading pretty much in the midpoint of the 52-week range, with a yield just under 3% and a forward PE of 15.19. Now their dividend safety sits at 99, very safe. They have one of the best balance sheets in the world. Market cap 391 billion. They are a mega cap company. In terms of those recessionary metrics, well, they increased the dividend during the last recession, above average growth, and they also significantly outperformed the S&P with a negative 27% return. You get a lot of consistency with Johnson & Johnson, 5.3% increase in April, so we are awaiting an increase next month, 6% over the last 5 years, 8% over the last 20 years. Not too bad if you're looking for some strong consistency. And they are a dividend king. They have increased those dividends for the last 61 years and been paying a dividend for the last 108 years without a reduction. In terms of dividend yield theory, we can see that sign of undervaluation, 2.94 versus 2.7, as well as the forward PE 15 sitting below that 16.4 level. And we do note it is slightly lower than healthcare sector PE of 17.3. In terms of the free cash flow payout, it did increase a little bit in 2022 and 2023 above that 60% level. What's nice to note is in 2024, they're expecting to bring this down to around 54%. In terms of the free cash flow per share, again, you do get a pretty strong amount of consistency with this company. It has increased over the longer term. 877, though, some strong growth expected into 2024. When we take a look at the sales growth, remember this is a fairly mature company, so we would expect steady moderate growth of 3 to 7%, and we got that in 2023, although we can see over the longer term there are some inconsistencies and not the greatest period from 2019 to 2022. Numerically speaking, though, we do see increase of 74 billion from 2014's number to 85 in 2023. In terms of shares outstanding, they have done share buybacks, not that much if I may add, and also not that consistent. Nonetheless, they have bought back around 300 million worth of shares over the last 10 years. ROIC, again, consistency, clear as day, 23% in 2023, so it does look fairly strong from that aspect, and again, for me, this is a very important metric to consider. Operating margin, again, very, very consistent. Free cash flow margin, again, not just consistent because consistency is one thing, but when it is very strong, well above the minimums on both operating and free cash flow, that is a very, very big bonus, and it could factor in when you are looking at that essential margin of safety. Net debt to EBITDA, phenomenal, 0.25 in 2023, 0.24 expected in 2024. So they do have a very nice balance sheet. And as I mentioned, amongst Microsoft as another company, they have one of the best rated balance sheets in the world. Now, when we look at their valuation, let's get to that intrinsic value. We get to a value for today's episode of $180. Now, on the current price, around 162, and our margin of safety of 10%, we can see it is pretty much a buy at the current price. There are some people who would buy Johnson & Johnson with a 10% margin of safety. Some people who'd want around 15 to 20. At a 15%, you'd be looking at 153. At 20%, around 144. In today's episode, though, it is around a 10% MOS level. In terms of Wall Street and their price forecast, well, they see a price of $178 over the next 12 months with upside of 10%, so they do still see this as a buy now. As always, let me know your thoughts in the comments. Were any of these ones that you are also buying? We have automatic data processing, eBay Incorporated, Comcast, as well as Johnson & Johnson. If you enjoyed today's episode, smash that like button, hit that subscribe and bell button so you are continually notified of these videos as they drop. And as always, we'll see you on the next one.